So transfer pricing and the changes we had. Transfer pricing rules have been for a long time reflecting the transactional values between the companies, and of course the transactional value would reflect ideally the value of the transaction that take place. In other words, following the principle called arm's length principle, which would assure that each company in the multinational group would be rewarded for the functions it performs, the risks it bears, and also the assets it owns or uses to generate income. This concept effectively exists not only in taxation, we also have it in accounting. We have actually the underlying principle of accounting would be similar. We account for transactions. We also need to kind of look whether transactions we account for reflect the true economic value, because if not, the financial statements will not be showing true and fair view in terms of the economic position of the company. And we have seen a lot of interaction between these two systems, taxation and accounting. The key developments, I would say, that have affected the transfer pricing and therefore have implications also in accounting profession is the gradual focus on other concept or principle we have both in accounting and taxation, that is substance. In accounting we have a concept called substance over form, and in taxation we have something similar, but in transfer pricing it's so much emphasized because we are valuing economic transactions. Now, if you have transaction in your accounts that you make a payment for something but the transaction didn't happen, then the question is to what extent it's appropriately reflecting the economic reality. Similar we have in transfer pricing, but not always this was the case. So the recent changes in the BEPS project would highlight that when we do transfer pricing analysis, we don't analyze paper transactions. We analyze what actually happens, so we analyze the substance. And based on an analysis, which we call accurate delineation of transaction, so we analyze if the transaction has happened, and if it has happened, who did what. We then go into the pricing to determine the appropriate arm's length price, and of course use the different methods. So that was one major change, or not change, emphasize, which has been always effectively there, but has been sometimes neglected by the accountants, but also the tax experts. The other important changes would be that what we saw before BEPS project, that the income did not always end up in places where the activities have been performed and value has been created. So there is much more focus about making sure that the outcomes of transfer pricing reflect the value creation by the multinational enterprise and the different entities in that multinational group. So we see special guidance develop in terms of intangibles, which was a very important element, making sure that entities which develop or provide other functions in respect of intangibles are appropriately remunerated, but also that the value of intangible is correctly reflected in other transactions, such as transactions with goods. If there is a presence of intangible asset, it will have impact on the price. And of course, other type of transactions which can involve even transfer of the intangibles themselves. We also saw enhanced guidance on the risk control, which would basically effectively allocate more profit to entities which don't necessarily legally own assets, but rather to entities which perform important functions which create those assets. So focusing on more economic ownership, so to say, rather than just the legal ownership. So these are some of the key elements that has emerged from the BEPS project, which was finalized in 2015. And of course, further work has happened since then in producing more guidance on the profit split method and other elements which could also have implications and can create tricky questions on how to account for such situations and transactions. Do we have really digital economy? That would be the first question I would push back, because actually one of our findings was that we don't necessarily have a sector called digital economy. We have economy which is overall, and it is becoming increasingly digitalized. We see penetration of the digital business models across the sectors and across the industries. So that was the first finding of the OECD, that we are talking about digitalized economy. And the trend continues and will continue. That one of the challenges we had was, let's say, the expectations, and maybe sometimes not met expectations of countries, which would expect to see income being booked in their jurisdictions and taxes paid on that income if multinational enterprise earns profits in that country. But the current rules, as they currently exist, don't necessarily make it possible, because we reward, in the first place, physical presence. We would allocate income to companies or to permanent establishments, which means some sort of a physical presence in the country. With digital business models, you can make income and profit without having physical presence. So that is the first element. Without having presence, you don't end up with income to be allocated, and that's where frustration of countries have been growing. In fact, it was already there during the BEPS project, but we couldn't agree on common approach on how to resolve that challenge. So since the BEPS project, the OECD has been working intensively, and we have issued several reports in the meantime. There was the interim report in 2018, which has outlined the key new business models which emerged, but also has reiterated it's not digital economy, it's the digitalized economy that we are experiencing. And also considered some possibilities for way forward, but especially considered or looked at the views of the countries. And unfortunately, countries are not of the same view. We have different perspectives among the different jurisdictions, which prevented us to make conclusions or reach conclusions in 2015, and also makes it quite difficult to find a solution now. The big news is that these divided views on how to solve the problem have been converted into work plan of OECD, that we work together with the jurisdictions to explore solutions which have been proposed by themselves. And in addition, the breaking news is that yesterday the OECD has released so-called unified approach, a proposal of OECD Secretariat to resolve that challenge or to find common answer or solution to this question. I think the key elements of that would actually mean that we may not use the traditional approach, arm's length principle, which I mentioned previously, because oftentimes you don't have physical presence, there is no presence, so how to use arm's length principle? So in fact, some sort of a formula may be contemplated to allocate some portion of income to in cases where there is no physical presence, or in cases where there is let's say, significant commercial activity, sales taking place, but not necessarily supported by, let's say, physical activities, or there is situations where you would have a model such as limited risk distributor model, where the company which makes the sale doesn't own the intangibles which help to make the sale, which is the marketing intangible. So these are some of the interesting news. Of course, it is not conclusions, it is only proposal of the Secretariat. We will have a public consultation in November, 21st, 22nd November, and that's where we will be interested to have views of public, whether they would agree with this approach, which on one side reallocates a portion of non-routine income, but also aims to bring more certainty in situations when there are routine activities taking place in a country, and also assuring there is no double taxation, and it's always resolved effectively through mandatory arbitration if necessary.